Hi, I'm Steve Bigger, Director of Equity Research at S&P Capital IQ. Welcome to this week's edition of Equity Analyst Forum. With me today on Equity Analyst Forum is Industrials Analyst Jim Corridor. Jim, welcome to the program.
Thanks for having me, Steve.
So this week's focus stock of the week is Trinity Industries. Can you tell us a bit about the company?
Sure. Trinity is the U.S.'s largest manufacturer of rail cars, used for coal, for oil and gas. They also lease rail cars, and they have another business with construction products, aggregates, other types of products as well, used in the construction industry.
So why is demand so strong then for rail cars right now?
Well, what's happening right now is that we're seeing surging oil and gas production in the United States. We're near record levels of production, levels we haven't seen in 20 years. And in fact, government resources think that over the next 20 years, we're actually going to overtake Saudi Arabia in terms of our production of oil. So all that oil needs to be transported. And right now, the main way it's being transported is via rail cars that get transported over rail lines. And that's what Trinity makes.
Okay. What about the stock? I mean, is that captured in the stock price already or not? And why would you like it right now?
Yeah, Trinity stock has seen strong performance, but the revenues actually have grown faster than the stock has risen. So we think that over the next several years, as we continue to see strong demand for oil prices, and that's reflected in railcar demand, the company should continue to see strong growth. They have a record backlog, and they also have a very visible revenue stream from the leasing of rail cars. So these two things lead us to believe that that revenue is going to be highly predictable, earnings should be predictable, and should have an upward trajectory, which is not fully reflected in the stock price.
Okay, and how about the valuation then? What's your target price and how do you get to that?
Yeah, the stock is trading at the low end of its range, and we think that certainly has a lot more room to run in terms of its target, and so that's why we have a strong buy on the stock.
Okay, how about risks? What would you highlight?
Yeah, I think the leading risk for the stock right now would be rising material costs. Obviously, they use a lot of metal. If we do see steel continue to rise in price, that would be a risk. Also, if we do see some kind of double dip recession or the economic growth slows, there may be some kind of pullback in orders, but the company is protected because it does have a strong backlog and a highly recurring revenue stream from the leasing business. So we think that risk is minimized a little bit for that reason.
Great. Thanks, Jim.
Thank you, Steve.
And that's been this week's edition of Equity Analyst Forum. We'll see you again next week.